Friends, welcome. In this session, we are going to learn the concept of cost of equity. Last session, we are discussing about the cost of debt. We have already understood cost of debt can be computed broadly under two methods. One shortcut methods we have learned, and another method where we have to compute the IRR. That also we had learned. To compute IRR, we had to refer to present value factor tables. That also we are aware of. Now, having learned this, now let us enter into a new concept, that is cost of equity. Going to share my screen with you right now. And the when that the capital consists of broadly two things. One is debt, other one is equity. So some of the concepts of equity, first of all, let us learn. Okay, what is, if someone is asking you what is the cost of equity, you can say it is the minimum return that the shareholders require from the company. That means shareholders are expecting that the company should give us this much. That is called cost of equity. For example, if a shareholder is expecting that you should give him a return of 20%, 20% is the cost of equity. If the shareholder is expecting that you should pay him, you should give a return of, let us say, 18%, the 18% is the cost of equity. So it is basically the shareholder's return, which is called as cost of equity. Okay, it is the return which is expected. And what the shareholders will expect, it depends on many things. But definitely shareholders will expect the minimum return, which is called as the risk-free rate of return, right? Plus something. What extra is asking for, that is called as the risk premium. This concept also we have learned earlier. Suppose a shareholders, without taking any risk, is earning 6%. When he is investing in equity, he will be expecting more because he's taking a risk. And at this context, at this situation, one more thing you need to understand, that the equity shareholders takes more risk than the debt holders. Why it is so? When a person is giving a debt to a company, what happens? To some extent, his money is assured. That means even if the companies or the business is incurring losses or profits, the business has to pay. The business has to pay interest. It has to repay the principal. But whereas equity shareholders will get money, will get return only when there is a profit or only when there is some uh, positive outcome of the business. So therefore, equity shareholders takes more risk. So their return depends on the fortunes of the business. Debt holders' return doesn't depend on the fortunes of the business. That is one more thing. Equity shareholders take more risk, debt holders take less risk. So therefore, equity shareholders will be expecting more return than the debt holders. Suppose a debt holder is expecting 12%, equity shareholders may expect 18% because he is taking more risk. In case there will be any loss in the business, equity shareholders is not going to get anything. He's taking more risk. Is it not? Since he's taking more risk, he'll be expecting more. And what the equity shareholder is expecting, that is the cost of equity for the business. Shareholders' expectation is the cost. Right? So because of this thing, cost of equity is always more than cost of debt. That is reason number one. Why cost of equity is more than cost of debt? If someone is asking you, you can say that equity shareholders take more risk, so they expect more return. And their expectation is the cost for the business. The other reason why debt is cheaper than equity is that when you are paying interest on debts, that interest becomes a deductible expenditure for tax purposes, for income tax purposes specifically. Interest is an expenditure. Because of that interest payment, your profit gets reduced. When profit gets reduced, you pay less tax. So there is a tax saving because of interest payment. So you might be paying interest 10 rupees, but you might be saving tax of 3 rupees by that. Because to the extent of 10 rupees, your profit gets reduced, right? So if you are at the tax bracket of 30%, then what happens? Your tax payment will be less by 3 rupees. So you are paying 10 rupees, but saving 3 rupees. Your effective cost is 7 rupees. So because of this tax shield, cost of debt is lower or less than cost of equity. Okay. These are the concepts which is shown to you in this slide, that what is cost of debt and what is cost of equity. And lastly, it says KE is more than KD. That is, cost of equity is more than cost of debt because of risk element, number one, and because of this tax shield or tax benefit. Okay, what I'm showing you right now is a share certificate. When a company issues shares, it issues a certificate like this. Okay, every company gives their certificate. Just have a look. Last session or few sessions back, I had shown you a bond. This is a share certificate. This is how share certificate looks like. Shareholders get certificates like this. Now, before computing cost of equity, some of the features that have impact on cost of equity, let us learn. First concept is that dividends are not predetermined. Unlike a debt instrument, unlike a bond, or unlike a debenture, in case of an equity, how much interest, how much dividend someone will get, nobody can say in advance. Okay, in bond debenture, what happens? We know that bond is, let's say, 8%. Bond means 8% is interest. Okay, and if you're taking a loan, you know this much of interest you have to pay. But in case of equity, right, we have to arrive at the profit. Then board has to recommend, shareholders has to approve, and dividend will be paid. So it depends largely on the profit. And in case of equity, one more thing is that there is no repayment of principal. The company or the business need not repay the equity part. In case of debt, it has to be repaid at the end of the term. Right? So that is fine. Or these are the two major concepts. And the next concept about cost of equity is that dividend is not tax deductible. Just now we are discussing that when you are taking, or a business is taking a debt and it pays interest, the interest becomes a tax deductible expenditure, which reduces the income tax. But dividend is not an expenditure. Dividend is a reward to the owners. In fact, equity shareholders are, who are they? They are the owners of the business. So whatever money paid to the owners, they are not expenditures. So therefore, dividend will not be treated as an expenditure. Right? Interest will be treated as an expense. Interest is paid to whom? Interest is paid to the outsiders. Okay, from whom you have borrowed money. They are your lenders. But dividend is paid to the owners. What is paid to the owners, that is not expenditure. But what is paid to outsiders, that is an expense. So dividend is not tax deductible. Next point is that dividend payment is given less priority over interest payment. Dividend is paid to whom? To the owners, to the shareholders. And interest is paid to whom? To the outsiders. So in every business, normally, first preference is given to the outsiders. Okay. First, what we will do, if there is some payment due to the outsiders, that is paid first. इसका मतलब पहले बाहर लोगों को सारी दे देंगे, फिर जो बचता है उसको क्या करेंगे, हम आपस में बांट लेंगे, वो है डिविडेंड. ठीक है. These are the some of the features, and we need to understand the features because they will be having impact on computation of cost of equity. Right? Now, certain principles you have to remember. First of all, okay, before you are seeing a formula, it's just a concept. It looks little complex, but if you listen carefully, you'll be able to understand it. 100% you'll be able to understand. First principle we have to understand. that this is again a concept. This concept says P0. P0 means price as today. Zero means right now. In a time scale, if you say zero means today, this one means after 1 year or 1 month, like this. So P0, that means today's price. This formula says today's price is the present value of future dividends. Suppose company is paying dividend at the end of year one. D1 means year one. D2 means dividend at the end of year two. D3 means dividend at the end of year three. So these are the dividends paid till DN. Okay. Because company doesn't die, company lasts forever. Dividends will be paid forever. So these are the dividends that you pay in future after 1 year, 2 year, 3 year, 4 year, like this. So if you can arrive at the present value of these dividends, इसका मतलब वो तो फ्यूचर में मिलेगा, लेकिन उसका अभी क्या वैल्यू अगर हमको पता चल जाता है, which is price P0, okay, then that price is the price or the value of that share. ये एक कंसेप्ट है. अच्छा, फ्यूचर डिविडेंड का प्रेजेंट वैल्यू कैसे पता चलेगा? आपको लास्ट क्लास में दिखा रहा था, प्रेजेंट वैल्यू फैक्टर, उसके मल्टीप्लाई करके कर सकते हो. और ये जो फॉर्मूला है 1 + r, 1 + r², 1 + r³ 1 + r⁴, like this. If you divide this thing, divide with the rate of return, you'll be getting price to pay. So just I wanted to explain you this concept that the value of the shares depends on the dividend. This is one more concept. Okay, so now by using that concept and by using few more concepts, we'll be learning how to compute this cost of equity. Now, very carefully watch this particular picture. These are various models. This models explains us how to compute cost of equity. First concept is called as the dividend valuation model. You see, there are two models. No growth is dividend. That means someone is saying the dividend is not growing. Every year dividend is same. Second is growth in dividend. If there is no growth in dividend, there is a perpetuity formula. We'll be learning that. You'll be apply that formula. You'll be getting cost of equity. If there is a growth in dividend, then again you have to see, is it a constant growth or step by step growth? The step of growth. So if there is a constant growth, there is a formula for this. If the step of growth, there is a trial and error method by using which we'll be computing the cost of equity. Fine. So this model says that on the basis of dividend, we'll be able to compute the cost of equity. Then you see one more approach. This is called as earning price approach. Here what happens? What is cost of equity? Is a company's earning. Earning may be different from dividends. If you know what is the earning, then divided by market price. Okay, you'll be knowing the cost of equity. And if growth is there, that may be added. If there's no growth, then growth need not be added. So earning by market price. The third formula talks about the realized yield approach. Here what happens, the formula is very simple. Whatever dividend is paid and whatever price is appreciated. That means for an investor, if he has received some dividend, plus if the share value has been appreciated, let's say the 10 rupees shares become 12 rupees. There is appreciation of 2 rupees. So 2 rupees is return, 2 rupees is yield, plus he has received, let us say, dividend of 1 rupee. So 1 rupee plus 2 rupees. This is the total yield divided by initial price. Initial price, let us say 10 rupees. So 2 rupees, 1 rupees plus 2 rupees divided by 10 rupees. Okay, so like this, one can calculate what is the yield. Okay, that means 3 rupees by 10 rupees. That means 30% is the cost of equity. This is what one can calculate. Okay, then you can see one more formula that is called the CAPM, which is referred to as capital asset pricing model. This model is giving a formula that's RF, that is risk to rate of return, plus beta, market beta factor is one factor. We'll be learning about this, multiplied with RM minus RF. So beta into market return minus risk-free rate of return. Okay, so if you do that thing, you'll be able to compute cost of equity. Okay, so this cost of equity computation can be done by using this type of formula. Okay, first we'll go to this no growth in dividend, how to compute cost of equity. You see, if you look at here, it is very simple. First one is situation one. No growth in dividend. So look at the formula. Simply, we have to apply a formula which is called the perpetuity formula. So here it says cost of equity is what? D1 by P0. D1 means dividend expected next year. 1 means after 1 year. So expected dividend by P0. Okay. Suppose today share price is 100 and dividend is expected next year, you'll be getting 18 rupees. So 18 by 100, very simple. 18% is the cost of dividend. 18% is the cost of equity. So I think you'll be able to do it. Okay. Fine. I think you have understood the first model, D1 by P0. Okay. Then we'll be seeing other models, or these models also you can do a question. Cost of equity, as you've seen, KE is equal to D1 by V0. So this is a question given to you on the basis of which we'll be able to compute. So we'll do one thing. Let us keep this question to the next class. Next class, I'll be discussing that question by using this model, how we'll be able to compute cost of equity. Okay, so today let us stop here. Thank you very much. Next class again will start, or you can recapitulate and learn the concept of cost of equity. Thank you.